Recording in progress. Yeah, so let's get it going. So just to start, because this is obviously a free session, but also some of my peers who are nice enough to trust me and for the remaining of the semester, I just want to share a little bit of the schedule. So for all of you, we are obviously June 2nd today. Obviously June 2nd, but we actually have quite a few additional courses left. We actually have 8 more courses left that we're going to do, 8 more sessions that we're going to do to best prepare you ahead of your final exam. And we're going to really cover every single topic that's new. So market efficiency, capital budgeting, TVM. I mean, and then look at the harder chapters again, like TVM and equity. And then we're going to do 3 separate individual mock exams with theory coverage and then another Q&A session. So the idea here is that you have a bunch of exposure available to you for, I believe, the best value out there in terms of just pricing, in terms of just time, in terms of somebody that actually cares. So that's very, very cool. So just for y'all that don't know what the next sessions will be like and when you could get some help again, well, this is definitely just an idea here. But yeah, so this will be put into the chat, the group chat as per usual. And it's going to give you a pretty good chance, a pretty good set of things to know and things to understand ahead of the final, but also just to understand things a little bit better and not be surprised and deal with bad grades again. I think it's absolutely ridiculous that the average on the midterm was 40%. And hopefully this could be another way to help such that the average on the final could be a little bit higher. And just for anybody who's wondering, the material onwards is material that's a little bit easier in the sense that it's a little bit more intuitive rather than complex like TVM, bonds, and equity. I mean, those are not things that we see every day. Whereas this idea of pricing and this idea of market efficiency and just profitability kind of makes more sense. So don't you worry. 1, it'll be easier from now on. But 2, I'm going to have a lot of resources available to you, free and paid, to make sure that we're not dealing with a classic 40% again. They're able to pass and feel fulfilled and all that good stuff. Anyways, that said, yeah, I guess I'll also show you that my prof said they'll, yeah, for sure, 100%. The final exam is cumulative, right? Which is why we're really covering everything within the next few sessions. And for those of you who are going to be in the member group and who are in the member group, I'm going to start administering homework. And I'm going to ask you to post your homework if feel free to be held accountable, such that you're being pushed on that path to the final and you really get to maximize your odds of getting good grades. But yes, totally. The final is cumulative. It's very cumulative. So you want to be able to have an understanding of all the questions. And that's why today, at the very beginning, we're going to do a refresher of chapter 8. So all things portfolio theory. And then we're going to move on to a little bit more of the CAPM stuff. But they're really very much interrelated. Another thing that I'd like to share is that we're going to be also covering a little midterm review, kind of either quickly on a Zoom, or I'll be sending the solutions in our member group. But what I'd like to say though, just really quickly, so I'll move this, whoops, I'll do this instead. What I'd like to say though is that if you don't already know, everybody that's in our member group, you have literally all of this available to you. And I would start looking at more exam 2 material right now, because there are solved mock exams with notes and solutions. There are previous mock exams with more ideas and perspectives, although this is for another class. And then there's just so many different resources available to you. So I would definitely do that. And then for those of you who don't already know, on YouTube, there are all these videos, although very cringe in my opinion, from my own perspective, but there are videos that are kind of useful that'll explain to you, listen, how do we do a CAPM question, right? How do we do it? It's totally free. It's out there for you. Use it, make sense of it. It's going to just make you better on your final exam. Anyway, so that's enough of my propaganda. Let's actually move on to some useful stuff for y'all. Okay. So that said, yeah, so the Google Drive, by the way, it's just for the members in the group. So the ones who actually kind of follow my weeklies, who do the sessions with me. So if you're interested in having that, just send me a message on Facebook. I'd be more than happy to share it. It's kind of like that. But once again, if you go on my website, there's a bunch of free resources. If you go on Facebook, you just search 308, there's a bunch of free resources. So if you don't want to pay, like there's so many things available out there. Anyways, enough of me talking about, unrelated stuff. So let's do it. So what I'd like to cover right now is a few little things, and we'll kind of look at it big picture. It's going to help you make sense of it all. So when we look at portfolio theory, okay, when we think about portfolio theory, what are we thinking about? We're thinking about we want to invest in two different things, right? It could be security A, it could be security B, it could be whatever you want. It could be Nike and Apple, it could be Microsoft and Nvidia, it could be so many different things. But the idea here is that we're investing in two different securities. We're investing in two different things, and those two different things will obviously constitute what we call a portfolio. So just really quickly, I want to make it super clear that we understand really quickly how to create, I guess I'll do this, how to create a portfolio. A portfolio, if at least of two assets, could look something like this, right? We have a piece of the pie and we're trying to distribute it in different ways to figure out what's the best portfolio available to us. So that's just a little bit of context, and it gets more applied in a second. So as you saw for your midterm in chapter 8, we're typically going to look at two things: the expected return and the standard deviation. The expected return is essentially how much money you should expect to make on this portfolio or on this asset. And the risk is, well, maybe you won't make so much money. And unfortunately, your money could be volatile. It could go from 0% returns to 20% return, et cetera, et cetera, et cetera. So that's very, very important. I won't go too much in detail for this because this is stuff that you've seen, but it's always good to have an idea. So let me just ask you quickly in the chat. Do we all know what expected return is, what the standard deviation is, and do we understand this idea of weight? Just say quickly yes or no in the chat, just from a big picture perspective, yes or no. You could just put a Y or an N in the chat. You could put a yes, you could put a no in the chat, or you could do nothing. Perfect, cool. So just a perspective. Now, what I wanted to do, okay, what I wanted to do is I wanted to create something that was kind of interactive, that can give you a perspective on what we're doing, okay? So what we're going to do right now is we're actually going to play around and make our own portfolio, okay? So in the chat, could somebody tell me what's a company that you would want to invest in? Somebody just say what's a company that you would want to invest in. What's a company that you'd want to invest in? Just put it in the chat. It could be anything. And then from there, DKM. So what's a company that you'd like to invest in? Can somebody just put any name? Apple, okay, cool. And then another one that's not already written there, maybe another portfolio, another asset. What would you like to invest in? We're gonna look at two assets. Then we're gonna look at how we make our own portfolio together. So anybody has an idea, write it in the chat super quickly. If not, I'll put another one, it's okay. Tesla, okay, cool, amazing, dope. So we have Apple and we have Tesla, all right? Let's give them random numbers. Let's say, can somebody tell me what would be the expected return if random? And yeah, what would be the expected return for Apple? Just give me a random number. Somebody put a random number in the chat. We're gonna make it fun. We're gonna make it interactive, and you're gonna see what we mean, okay? So what is 10%? Amazing, cool. And then what about what should you call it? What about Tesla? How much for Tesla? Let's build it together. What's the percentage for Tesla? Anybody? 13%. Okay, cool. And then risk, we're going to do whatever. We're going to put, well, even before we get there, okay? Before we get there, let's say, all right, let's say that if we were to be 100% invested in security A, so in Tesla, if we were to be 100% invested in Tesla, can somebody tell me what would be our expected return? If we were 100% invested in Tesla, what would be our expected return? Can there be a negative expected return? Hopefully not, but technically, no, the answer is no, because prices cannot be $0, but yeah. Technically, yes, it could be because that we'll look at after, but that's a whole different topic. Can somebody tell me what would, let's invest 100% in this idea of Apple, okay? So by definition, we would be invested 0% in Tesla. And for that reason, if we're 100% invested in Apple, what's really interesting, if you look at the graph that we have right here, which is the expected return graph, you would notice that if we're 100% invested in Apple, we would obviously have a return of 13%. But what's really interesting is that if we're 100% invested, for example, in, call it Tesla, right? Actually, I think there's a small mistake. Let me just do this real quick. 13% would be security A. Let's do this. But the idea here is what I'm trying to do is I'm just trying to show you guys what would happen. There you go. Give me a sec. But the idea here, I guess I'll stop trying to be so interactive, but the idea here is that what I'm trying to showcase is that this graph that you see when your teachers are making, when you're in class or when you're looking at notes, what you're seeing is that they're typically going to show you this graph in which you're going to have the weight of a security, right? You're going to have the weight of a security, and they're going to tell you, well, listen, you could be 0% invested in a given security. You could also be 100% invested in another security, okay? And by definition, if you are 100% invested in a security, you will be 0% invested in another security called security B. So what I was trying to do right now, I was just trying to showcase to you what would happen if we were to build an arbitrary portfolio together and see how we would run through this idea of our portfolio being located on this little graph. So what I'd like to showcase right now. So let's say, right, and I'll put some random numbers here for our risk, but let's say, all right, let's say that we are invested, call it 50% in security A and 50% in security B. So once again, that means that we're, call it an Apple and then Tesla. So what's really interesting here is that you notice that we're obviously going to be at the middle of this graph. We're going to be right here. We're going to be at a point at which our expected return will literally be 50% times 10% plus 50% times 13%. Okay, so that's just a way to look at it. And then what's really interesting is that we notice, because we know that the expected return of our portfolio is simply the sum of weight A times the expected return of A plus weight B times the expected return of B, we would get this as our expected return for our portfolio, okay? But what's, once again, really interesting, and I'm gonna ask y'all in the chat because I've been talking so much, what would be the expected return of our portfolio, okay? What would be the expected return of our portfolio if we were to be, call it 100% invested in Tesla? What would be, so Parth says 13, that's amazing, yes. So if we were to be 100% invested in Tesla, and I'll kind of erase some stuff so it's more readable, you notice that, of course, our portfolio is right here, right? We are at 13%. And then let me ask you another question. If we were to be 0% invested in Tesla, what would be the expected return of our portfolio? Where would we be on our line? Somebody tell me what would be 100%? It would be 10%. You guys killed it. Yeah, we would be at 100%, and then our portfolio would be right here. Notice this little point? So that's the perspective here. I just want you to visualize why this makes sense. And the reason why I'm doing this is because if you look at the documents that you have accessible to you, especially those who are in my, my member group, I'll flash it right now on the screen, is that there's this little perspective here. And I guess I could try to zoom in as much as I can. This is something that you'll typically see in your notes, okay? You'll typically see this idea of the relationship between, different stocks if you'd have to make a portfolio. And I think that when you just see this once, right, one time in class, it kind of seems overwhelming. But if you could use this, this perspective right here as we've done, it makes it a little bit easier to make sense of what we're doing. Okay. So now I'm going to be a little bit annoying because I want you to be able to kind of quickly see what happens if, let's say, that we were invested, call it 30%. Okay, and I'll write it here. Can somebody tell me what would happen if we were 30%, okay, in Tesla, so in B, and 70% in, in A? Can somebody tell me what would be our expected return? Can somebody tell me what would be our expected return in the chat? It should take like 2 seconds to do. It shouldn't be very hard. It's a simple computation. I would just want you quickly to tell me what it is. And Parth is a genius. Hell yeah. So we would be at 30% here. And then by definition, we would have, it's a little bit close. It would be 10.9. You put 10.6, but it would be 10.9 if we would do it. All right. So that's the beauty of it all. You're able to see what it is. All right. Now, the last thing that I'd like to cover, is this idea, all right, for this little page, this idea of what we call risk, okay? Risk, essentially, is simply looking at the volatility of a stock, okay? And this is something that we're going to look a little bit more in detail in the next slide, but I just want you to understand this idea of volatility, okay? You may lose the money that you're expected to make, right? We have an expected return, and we're essentially assessing the way that expected return could either go up or go down through time, okay? And what's really, really cool, and I think this is the most valuable thing to kind of have here, because this is something that relates to risk and it relates to this idea of diversification, is, well, what happens what happens based on the correlation or the covariance of two stocks? What happens when we have two stocks, and what happens when they have different correlation coefficients or different covariances, okay? And the graph that we have right here, and I'll bring it, I'll bring it here, so it's very big, and I'll put a filler in the back so it's white and we don't see anything. So solid fill. I don't know. All right, so what we have right here is going to be a really good exercise to figure out what's the risk of our portfolio. Okay, it's going to be a very good exercise to figure out what's the risk of any given portfolio. Now, what I'm really focused on right now is I want to look at this idea of the correlation coefficient. I really want to double down on the correlation coefficient. Now, I'm going to be annoying because I hate talking too much. I feel like maybe that doesn't conduct, a lot of learning. Can somebody tell me, what is a correlation coefficient? In your own words, there's no right answer. What is a correlation coefficient? Write it in the chat. What is that? What does that do? What is it trying to do? What do you think it is? What is a correlation coefficient? What does it tell us? So you just write it in the chat. I'll give you like 30 seconds. If nobody answers, I'll just say it. Okay, yeah, 100%, exactly. The movement of the stocks. And what's really cool here, and I guess I could use 2 little examples. What's really cool with this idea of the correlation coefficient and the covariance is that it's telling us, well, how are 2 separate things moving together? Okay, a positive correlation coefficient or covariance means that if this moves upwards, this will move upwards as well. A negative correlation coefficient means that if this moves upwards, this will move downwards, okay? So we're looking at the relationship in movement between 2 variables. And in this case, we're looking at the relationship in movement between 2 stocks. Now, something that I've seen several times in exams, it doesn't mean that it'll be in yours, is this idea of what the correlation coefficient is all about. The correlation coefficient is a very, very finite measure of the relationship between 2 variables, okay? It's finite. And the correlation coefficient, what's really cool, is that it could only be between a specific set of bounds. That's what it means for something to be finite, right? And those bounds, and I guess I could write it right here in red. I guess I'll write it here, actually. The bounds for the correlation coefficient is literally as simple as this. It's -1 to 1. Now, if you guys remember from Math 209, this is something that you'll see. Essentially, what this means is that the most important correlation coefficients that really dictate a strong analysis, right, will be the following. It'll be 1, 0, and then -1. So what I'd like to do here is that I'm going to show you what risks really means by looking at these 3 different bounds, okay? And I'm just going to sneeze. Sorry. So what this means is that, let's say, I think I'm going to go, I'm going to go blow my nose real quick and I'll be right back. But essentially what we're going to do is we're going to look at those 3 different correlation sets, and you're going to see why diversification matters. So give me a sec, I'll be right back. Sorry about that. That's pretty gross and kind of funny. But anyways, what we're going to do now is we're going to look at something super interesting. So by definition, if we have a correlation coefficient of 1, does this mean that the stocks will be moving in the same direction, opposite directions, or we don't care? Can somebody tell me in the chat? If we have a correlation coefficient of 1, what does that mean? Same direction, opposite directions, or nada? Yeah, they're going to move in the same direction, okay? So if they're moving in the same direction, what's really interesting is that you get to notice that there seems to be no real value in having a portfolio made of the 2 securities, right? Because nothing's really happening to our risk. Our risk, as you can see, there just seems to be a straight line. There seems to be no clear value. So in this case, if I were to invest in a stock, I would say, and we're just normal humans, I would say, you know what? I will just invest in security A, because it seems to have the least amount of risk in terms of just a risk perspective, okay? Now, what's really interesting is that, let's say we're looking at a correlation coefficient, so a correlation coefficient of like 0, okay? So they're not necessarily moving in the same direction, and they're not necessarily moving in opposite directions, okay? Well, what's interesting is that if you have a correlation coefficient of 0, you notice that you get to a point, or several points, at which your portfolio has a risk that is actually smaller than those individual stocks in themselves. As you can see right here, we have a portfolio risk that's smaller than both 8% and 10%. That's some very powerful stuff. This idea here now, this insight that we're able to drive here, and I'm just speaking a lot because I want you to get a sense of what we're doing, is that when you diversify, when you invest in other than one singular stock, if you pick your stocks the right way, you're going to be able to get a portfolio that has a smaller risk profile than those individual stocks. So what I'm saying here is that instead of just investing in Apple alone or Tesla alone, if you invest in both and they don't move in the same direction all the time, you could actually be exposed to risk that's less than those 2 individual stocks. That's the value, okay? That's the real tangible value there. Does that make sense to everybody in the chat? Is that a visual representation that we understand? Just a quick yes or no, just so I make sure that we're still on the same track together. Okay, super cool. I'm going to assume that we're on the same page. We're still doing a refresher. Now, is there anybody that does not understand what we just did? I think that's a better question to ask. Anyways. Okay, by the way, if you have a question, yeah, Nar, what's up?
Yeah, I have a question. So it's always better to have a lower standard portfolio than security A and B.
It's always better to have,
like in this case, is portfolio of standard is lower than A and B, 10 and 8. So this is better.
Yeah, exactly. The idea here, it's a good question. It's an amazing question. The idea here is that when we have a portfolio, we're able to have multiple, exposure to returns and multiple exposure to risk profiles, right? But what's really interesting is that typically assets or stocks don't move in the same direction. Okay, so if the price of one goes up, the other may not go up as well. And if the price of one stock goes down, the other one may not go down as well. So that's really interesting. And because of that, we're able to have, right? We're able to have a portfolio risk, right? This is portfolio risk. Whoops. That's going to be smaller, right? Than 10% and 8%. It could be any number, right? The idea is that portfolio P will be smaller than portfolio A. Then risk A, and then risk of the portfolio will be smaller than the risk of the other assets. So this would be Apple, and this would be Nike. So that's the value here. Okay, that's an amazing question part. I got a question. I'll answer that one, then I'll get back to you, Nar. Is that if we have a correlation coefficient of -1, we get to something even more interesting. We get to a point at which there's even the possibility of having 0% risk. We're able to get a scenario at which we have 0% risk, okay? That's pretty cool. There's a point at which we have 0% risk. And I guess we could say maybe that call it 45% or 55%, like this. So if we invest 55% in Tesla and 45% in Apple, we're able to get to a point at which we're literally going to have almost zero risk. I think we could all agree that having zero risk is better than having some risk, right? We're literally telling you that your returns are guaranteed. You're for sure going to make that money no matter what, okay? So that's the idea here. There's a point, if you have, correlation coefficient of -1, that you're able to have a risk profile for your portfolio that's equal or closer to 0%. And another point that I think is really interesting is that very quickly, no matter where really on this line, we're better off in our portfolio than just investing in those individual stocks very, very quickly. So that's a very important notion. I'm trying to reinforce this idea that investing, I think that's an amazing, amazing, amazing insight. Because the correlation coefficient can be no bigger than 1, anything smaller than 1 is a W because of that fact. So yes, the lower the correlation coefficient, the lower the risk, the better your exposure, right? That's the idea, okay? When you have two assets. So that's super interesting, okay? Very, very important notions. And the reason why I made this, by the way, and this is a document that's available to everybody here, is when you're studying, this could be something powerful to use because it'll give you visual cues as you're doing questions, right? You could literally plug in the numbers from the question that you're studying and kind of make sense of what's going on. And I think that's a powerful way to understand questions rather than just do them, okay? And this is totally super you could play with it. You could put 5%, you could put 6%, you could put 3%, you could put 1%. You could play around with this so many different ways. You could put this at 0.5, put this at 0, you could play around. So it's pretty cool. Now, that's what I'd like to share, okay? Before I take any more questions, I'm just gonna talk about an idea, okay? Just for you to really understand what we mean by looking at two stocks, okay? And this is gonna be something that's gonna be useful to you post, Com 308 and in your life as well. So let's say we're looking at two stocks, and we're going to look at their returns every day for the last year. Is that clear to everybody? We're looking at two stocks, and we're going to look at their returns on a daily basis for the last year. Quick yes in the chat to say that's clear. Just quick yes, so you understand what we're looking at. Okay? Yeah, amazing. So what we have here, I guess I'll zoom out a little bit. What we have here is we have Apple, okay? And we have from June 2021 all the way to essentially right here, June 2022. And as you can notice, the price is going up and then it's going down, okay? That's just a quick little perspective. And what we could do because we're smart finance people, we're able to find the average return from this stock over the last year, and we're also able to find the risk of our stock. So just for you to have visual cues, our average returns would be our expected return, so ER. We could call this ERA. And our risk essentially would be our standard deviation. So we could call this standard deviation A. Okay. And we did the same thing for for Microsoft. We did the same thing for Microsoft. So we have ER B, and then we have risk B. Okay. So we did the same thing for both assets. Now we have a good perspective, and we want to invest in both Apple and Microsoft. And these are the only two companies that we can invest in. Okay. Very, very crucial. What I wanted to do is I wanted to just argue why it's important to kind of understand this idea of diversification. And we're going to talk about it more afterwards, but it's always important to understand why this makes sense and what we're trying to accomplish here. Okay, what we're trying to accomplish. So obviously, if we just kind of take a step back, but I want y'all to be able to understand, if we look at this period, right? Here, we're going up all the way here, and then we're going down here. Okay, so if we look at the period of October 1st all the way to call it February, as you can notice, we went up, then we went down. And it seems like we had quite a big difference, right? We had quite a big difference. So can somebody tell me like approximately how much money, let's say if we were invested here, have we lost at point B? Just in dollars. Can somebody tell me how much money you think by just looking at the graph, like really quickly? We have our time here and we have our price here. Okay, can somebody tell me quickly how much money did we lose in Apple? I mean, in Microsoft. I don't know. How much money did we lose? I need a few answers just so I can make sure that we all know how to read graphs. How much money did we lose approximately? It doesn't have to be on the nose. It could just be an approximate. How much money? You'll see why this matters in just a second. So part says $100. Yeah, so it seems like we lost $100. Okay. And then let's look at the same scenario here. Let's look at the same date. So let's look at A here, and let's look at, call it B here. How much money did we lose then? Can somebody tell me? How much money did we lose then? I'm only doing a quick 1 minute understanding of this. How much money did we lose then? So we just say it in the chat. If we were here, how much money did we lose then between the two? How much money? Is it $1, $2, $1 million, $50? How much? What was the change in stock price from this point, let's call it, all the way to this point-ish, or like this point? Yeah, 50-ish. Thank you. Amazing. 50-ish. So now let me ask you this. A very simple question in the chat. Would you rather lose $100 or would you rather lose $50? What would you rather lose in the chat? $50 or $100? 50 bucks. You would rather lose 50 bucks than 100 bucks. So that's the idea of when you have different stocks, you want to be exposed differently at those stocks. You want to be exposed differently at those fluctuations of the stock. And what I'd like to discuss, the last point right here, so you have a visual, like a visual representation, I'll put it in green, is that what we call this difference, okay, I guess this difference right here, from the difference right here is what we call volatility. This is a stock that was volatile at that point right here, okay? That's a volatile stock. This is what we mean by risk. What is happening to your money, right? Let's say your money was supposed to be constant or at least growing, but if it's going up and going down and going up and going down, that's what we call risk. And that's exactly what we're trying to denote with these things right here. That's exactly what we're trying to denote with these things right here. Okay, so that's a perspective, just for you to kind of get a sense of what we're doing. Now, what I would like to cover, and this will be the last thing that we're going to cover before we move on into CAPM and all the beauties of CAPM, is that what do we notice here is that let's say we were to build a portfolio of both Microsoft and Apple. I think we could all agree that we found our returns and we found our risk profiles. Does this seem fair to everybody here? Is this clear what we have right here? Yeah, yes or no? Pretty clear that we have our returns and that we have our risk. Just a quick yes or no in the chat. Okay, cool. All right, cool. So we have this as our risk, as our risk, and then we have this as our return. So very cool stuff. Now, what I'd like to say is that technically, there should be an infinite set of proportions that we could invest our money in. Okay, let me say this. Let's say we had $100 to invest in Apple and Nike. Let's call this Apple, and then this Nike, Microsoft, and Microsoft. Technically, if we have $100, technically, we could do this, for example. We could do like $1 in Apple and then $99 in Microsoft. But then we could do $1.01 and then $98.99 and so forth. We can break down our distribution in a million different ways, right? We could do $1 in Apple, then $2 in Apple, and then vice versa, $99 in Microsoft, $98 in Microsoft, and so forth. Does it make sense that we have an infinite set of distributions, of proportions, of distributions of our wealth, of our weight in these two assets? Does that make sense to everybody? That we have an infinite set of different proportions at which we could invest ourselves in these two stocks. Yes, I just see one yes. Does that make sense? Okay, cool. Well, because of that, what we could do is we could try to make sense of all those different combinations. For example, where we are 20% invested, I guess I'll go here. Yeah. Where we are, call it 0% invested in security A, but then 1 minus this, but 100% in security B. So 100% in Apple, 0% in Apple, 0% in Microsoft, but 100% in Apple, and then 1% in Microsoft, and then, and so forth, all the way to infinity. So there's a bunch of different ways that we could be invested in these two stocks. That's what I'm trying to say, and I hope it's clear. I hope it's very clear that we could be invested in both these stocks, right? So that's the idea. There's an infinite set. And because there's an infinite set of ways that we could be invested in both these stocks, by definition, we're going to have different expected returns and different standard deviations available to us relative to the weights that we've allocated to both of these stocks. Okay, let me say that one more time. Because there's an infinite set, okay, there's an infinite set of proportions at which we could invest in Microsoft and Apple to formulate our portfolio, there will then be an infinite set of standard deviations and expected returns available to us, because we're going to be looking at a bunch of different profiles, a bunch of different possibilities for this investment. Okay, that's super duper important. Now, because we understand the formulas and we did them, what I want to be able to showcase is well, how does this look? And how does this look is exactly what we call our efficient frontier. Our efficient frontier is quite literally, if I zoom out to 120%, is quite literally the combination, all the possible combinations of this portfolio that we're trying to build together. We were trying to build a portfolio of Apple and Microsoft, all right? And there's a bunch of different weights that we could have. And all of these different weights could be essentially graphed like this. This is one weight. This is another weight. There's another weight here. There's a bunch of different ways that we could create our portfolios, right? And now the question is that, how do we find the best portfolio out of all of them, right? That's the idea. We want to be able to find the best portfolio, right? The best combination of Microsoft and Apple within all of the combinations available. Does that make sense to everybody in the chat? That we're trying to find the best combination out of all the combinations available. Is that fair? Quick yes or no. Is that fair that we want to find the best combination out of all the combinations available? Did I lose anybody? Do we have any questions? Like we would choose, yeah, 100%. Obviously, NAR in an exam, they're going to give you the percentages, okay? But in this case, we're just looking at all of them. Just for you to really understand, if they ask you a theory question, what the hell is the efficient frontier? With the efficient frontier, we took into account the correlation coefficient when we calculated our standard deviation. If you remember, the formula of our standard deviation, I guess, could be simply broken down as being like this. Remember when we wanted to calculate our standard deviation, it looked something like this, okay? This is how we calculate our standard deviation, and we could use both the covariance or the correlation coefficient, depending on, you know, how you want to do it. They are both great. They're both available for free on the website. But what I want you to understand is that once we found, right, the expected return and the standard deviation, we're able to do that for every single, you know, mixtures of weight A and weight B, okay? So we're able to make our efficient frontier, which essentially has all the different combinations available, right, for Microsoft and Apple together as a portfolio. And with that, we're going to try to find the best portfolio available to us. Do we understand why we want to find the best available portfolio? Because we want to make the most money for the less amount of risk possible. Is that a fair statement to everybody here? Does that seem fair? We want the best portfolio because we want to minimize risk and optimize returns. We want to have the most money possible with the less amount of volatility, the less amount of risk possible. Okay? So that said, what I just did here is I just zoomed in every single time. Yeah, okay, so that's a great question, Parth. So that's why I like this, because we get to start a conversation, which is something that we don't always do in class, right? In class, it's kind of like go, go, go. What I did here is I looked at a very objective set of what we did is essentially we looked at an objective set. Whoops. I'm just gonna do this again. Sorry about that. There you go. What we did right here is we looked at an objective set of combinations available, right? Our profile, our risk aversion, or our relationship to risk is something super subjective, and that's going to change from person to person. However, the standard deviation of that portfolio and the expected return of that portfolio will never change, right? There's an infinite set of standard deviations available and an infinite set of expected returns available. And I tried to map a few out right here, right? If we were essentially 100% or 20% or 60%, all of the different combinations, all of these different combinations will remain and exist regardless of our relationship to risk. Our relationship to risk will dictate which portfolio we choose. Okay, let me say that one more time. Our relationship to risk will dictate which portfolio we choose. However, there will still be, no matter what decision we make, an infinite set of portfolios available for us to choose. I want to make that super clear. Do we understand that this is the infinite set of portfolios available? And we're going to try to choose the best one available out there based on our preferences. But in this case, we're only going to look at one preference. Okay, that's the idea. Now, that said, as we, whoops, I just tried to zoom in, you know, for each, just for you to really be able to see that what you have here, what we did is exactly what you have in your books. It's exactly this idea of the line that you see in your class. So just a really good visual representation, okay? So before we move on to the capital allocation line, which is gonna touch a lot, no pun intended, because we're going to look at a tangent line, but it's going to touch a lot on this idea of the efficient frontier. So for now, do we have any questions about this efficient frontier? Do we have any questions? Like, all the questions in the world are available. Do we have any questions about the efficient frontier? So I see a no. Anything is cool. Everything is good. All G, all good. Okay, cool. So I'm just gonna drink some water real quick. By the way, we're totally gonna do some questions after. So don't worry, you're gonna see it applied as well. And there's 20 videos literally only on CAPM and things related on YouTube. So you have amazing exposure. Okay, so that said, what I'd like to quickly showcase. Yeah, exactly. So the CAL and the CML essentially are not the same thing. The CML is a specific version of the CAL. The CAL is a capital allocation line, okay? So essentially the CAL, I think a really good way to think about it is how a normal person like yourself or me or who, people in our surroundings that have, a decent amount of money that we want to invest, but it's not $1 billion. We're going to look at the CAL because we're going to try to figure out how we're going to allocate our own capital into assets. Capital could be $5. An asset could be a stock. So the CAL is really just us trying to figure out how we're going to allocate our money into stocks, okay, into different assets. And in this case, the CAL is we're going to look at the relationship, okay, with the CAL of risk to expected return. Okay, we're going to look at the relationship of risk to expected return, and I'm going to try to quickly show what that looks like. So just give me a sec. We're going to look at the relationship of risk to expected return. So I'm going to throw out a little paper after that we can look at together. But anyways, so yeah, we're looking at that. So this is a formula really quickly, and we're going to double down on the formula a little bit more afterwards. But I just want to talk about the ideas first, okay? So the capital allocation line is essentially us trying to figure out, okay, what is the absolute best portfolio available to us, okay? We're trying to figure out what is the absolute best portfolio available to us, okay? So what we're going to do with our capital allocation line is we're going to try to figure out, okay, from our efficient frontier that we have right here, this is our efficient frontier. We're going to try to figure out, well, which one gives us the most return for the amount of risk that we take, okay? This is very important. We're going to try to figure out which gives us the most return, okay? The most return for the least amount of risk, okay? Now you may ask yourself, why are we looking at it from that perspective? Why does that matter to us, okay? Well, the reason why this matters to us is I could actually pinpoint it in a very, straightforward way, is that, well, let's say, okay? Let's say that every time you invest $10, you lose $2, okay? But then there's another scenario at which every time you invest $10, you lose $5, okay? This is scenario A and this is scenario B. Which scenario would you rather? I think that's an amazing way to explain it. Which scenario would you rather? Okay, so I have one answer. I need everybody to answer here. So every time you invest $10, you lose 2. So I think we could all agree that scenario A is the best out of the scenarios available to us. Unfortunately, in life, there's no real way to never spend money on stuff, right? No matter what, you're going to have a mortgage in the future. You're going to have, a car expense, or you're going to have to buy food. So what we're trying to figure out is for what you're spending, how much money are you going to keep, right? For the money you make, how much are you spending out? In this case, we have 2 scenarios, scenario A and scenario B, one in which you're both making $10, but these 2 scenarios have different, outflows, okay? So just to summarize, we would all agree that A is a better scenario, right? We're losing less money for the money we make. Then let me ask you quickly in the chat, just for fun. If we would do 10 divided by 2 and 10 divided by 5, could somebody tell me what those answers are in the chat? What is the answer for A? 10 divided by 2. Okay, it's $5. Amazing. And then what about scenario B? 10 divided by 5. $2. Okay, cool. That's super important. Essentially, what we're saying here, okay, and this I think is very important. In scenario A, what we're saying is that for every $5 you make, you're going to need to spend $1. Okay? And in scenario B, we're telling you that for every $2 you make, you're going to have to spend $1. Does that make sense to everybody? Does that seem fair? If we want to like break it down into like a proportional like line and something that's reasonable and like a forecast, does that make sense to everybody? Just a yes or no in the chat. Yeah, 100%. Okay, cool. So what I was saying here is that, right, let's say if you make $10, you need to spend $2. We could say that for every $5 that you have, you need to spend $1, right? Does that make sense to you, Charlene? For every $5 you have, you need to spend $1. Okay, cool, same page. So the reason why we need to do this little exercise when we're looking at our efficient frontier, it's because, unfortunately, our efficient frontier is super, super interesting. As you can notice, we could have a point right here. We're going to call this point A. And we could have a point right here, which we call point B. So as you can notice, okay, as you can notice, for the same amount of risk, you are getting two different types of expected returns, right? For the same amount of risk, you're getting two different types of expected returns. Is this something that we could all see on this graph? Quick yes or no in the chat. Is this something that we could all see in the graph? Yeah, 100%. Okay, cool. So I think if I ask you a question, which gives us the best return to risk payout? Which gives us the best return to risk like trade-off? Which one, A or B? Which is giving us the best risk to return to risk or whatever the case, payoff? A lot of people are saying A, and A is definitely the answer, right? We really need to do this because we know that within the combination available to us, there may be some that have the same expected return, but not the same standard deviation. And there may be some points that have the same standard deviation, but not the same returns. So that's why it's super important for us to figure out what the hell are we dealing with and which one is the best, sorry about that, which one is the best combination available to us. And once again, this is why we really need to figure out which one is the best combination. Now, let me talk to you a little bit more about how we figure out, especially related to the CAL, so the CAL, and the CML, the capital market line. How do we figure out what is the best, absolute best portfolio available to us or combination available to us within our efficient frontier? How do we do that? So the way we do that, technically, actually, let me ask you in the chat. I spoke about it a lot at this point. How do we figure out the best combination? Like, what's one method we could use to figure out the best combination? Could somebody tell me in the chat? I feel like it's almost written on the screen. How do we figure out the best combination? How do we figure it out? You don't have to like, there's no right answer. Just like write in your own words. How do we figure out which is giving us the best, return for our risk across the different combinations available to us? Okay, let me say that one more time. Maybe I'm not being clear. We have all these different combinations. How do we figure out which one's the best? How do we figure out which one's the best? Okay, that's one good answer. Yes, Parth, that's one good way. But what's another way that we could look at it? Just simple, like a 5-year-old could do it. Like just one quick way. It's a division. It's a division. Oh, there you go. Exactly. Return over risk. The way we want to do this, okay? The way we could do this, I think, could we all agree that looking at the returns that we have over the risk that we could potentially have is a decent way for us to figure out what's our trade-off for every unit of risk we take? Does that make sense? Am I not being clear? I don't know. You tell me. Does that make sense? We could even go back here if you want. This would be a nice. Yeah. We have an infinite set. Okay, we have an infinite set of combinations. This is combination 1, this is combination 2, there's combination 3. There's so many combinations, okay? There's an infinite set of combinations. And we quickly want to be able to figure out which one is the best combination. So what we could do is we could do the expected return divided by the risk. And we could do that here. We could do that here. We could do it everywhere, okay? And the one that gives us the best expected return to risk is actually the tangent line, by the way, just to make it clear to everybody. It's actually the tangent line. But the reason why I want to just double down on this before we get there is because there's a topic that you will see a lot, and I feel like teachers are not doing a good job on it. Is this idea of the Sharpe ratio, okay? And the Sharpe ratio, which is funny, is actually this thing right here. This is the Sharpe ratio. This is our formula for the cal. Okay, this is our formula for the cal. And you notice that there's this thing that we have right here. And this is what we call the Sharpe ratio. Okay, and if you could notice really quickly, is that it's essentially almost the same thing as we just did. As you can notice, we're simply doing our return divided by our risk. Can everybody see that this is just the return over the risk plus one little thing? Do we see the similarities that ERM over sigma M is typically return over risk? Is that something that's clear to everybody in the chat? Really quickly, do we see the similarities? Okay, the reason why it's the case is because the Sharpe ratio is just a really good way for us to figure out what is the return, what is the payoff, what is the compensation we're getting for every single unit of risk we're taking, okay? And now you may ask yourself, what is this? Can somebody tell me in the chat what this is, this thing right here? What is this little thing that we have right here? It's the risk-free, okay? The reason why we're adding, okay, the reason why we're changing our return over risk formula as our benchmark to essentially return minus RF, okay, over risk, is because we want to be compensated for the risk we take. Now, what does that mean, to be compensated for the risk you take? Let me give you an example, okay? Let us say that we all work the same job, okay? We all work the same office job and we all make $50,000 a year, okay? We all do that. We all work the same office job and we make $50,000 a year, okay? For us to be willing to take on a new project or another job, should we make more money or less money than the job that we have right now? Would you want more than 50K or would you want less than 50K? What would you guys think? Do we want more money if we're going to take on a new job that's really risky? Quick more or less in the chat, just for fun. I'm seeing 2 mores, which is great. Let me say it one more time. If we all have the same office job that pays $50,000 a year, okay? And somebody comes to us and say, hey, you could get a brand new job, it's really risky. Would you require that job to pay you more or less? So Parth and Sarah says more, Charlene says more. Exactly, the answer is more, okay? Because you need to beat the benchmark that's available to you and all of your peers, right? You need to beat the benchmark that's available to everybody else without taking any risk. We need to beat the salary that we have without taking on any extra risk, okay? That's what we call the risk-free. Essentially, we're comparing the return, the money we could get on another job, to the risk-free job that we have right now. This is a metaphor to say that the reason why we have this formula right here, ERM minus RF over sigma M, or just returns minus risk-free rate over sigma, is because we're trying to compare the return we're available to get versus the return that we could get without taking any risk at all. That's why we have this formula called the Sharpe ratio. The Sharpe ratio is simply looking at what is the additional compensation you're getting, what are the additional returns you're getting for the risk that you're going to overtake. Okay, does that give you a better sense of what the Sharpe ratio is all about? Quick yes or no in the chat. Okay, cool. That's one way to look at it. All right, very, very, very important. Okay, so this is super cool. So we understand that. Now, what I'd like to say is that essentially what we have here, okay, what we have here, and before we even get there, I'll just show you what, a line could actually look like, okay? If we were to have, our risk-free rate, okay, I guess I'll move this here. We'll move this here. I'll erase a few things. Give me a sec, such that we can move on. There you go. Okay. Okay. So we know that this is our formula, right? We know this is our formula, blah, 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 from which we're able to actually have our efficient frontier, just like this. And we're going to have our tangent portfolio, and that's going to give us essentially our CAL, our capital allocation line, okay? That's our capital allocation line. A few things that I'd like to just point out really quickly is that our capital allocation line, I think we can all agree that it's literally a proportional line. It's a linear function, okay? It's a linear function, and as you can see, why it's a linear function is because it's literally a straight line like this, and it goes under the form of y equals mx plus b, okay? From which b is going to be the intercept, okay? And then m is going to be the slope. Then x will be our independent variable, so this is our x. And then our output will be y, which is our vertical axis, which is our y, okay? Just a quick few pointers. What's really, really interesting is that you could also use this when you're doing a exam, or when you're doing not an exam, because that's not it. When you're studying for your exam, is that you could really play around with this and look at what happens based on the different scenarios that you want. So as you can see, based on the different scenarios that you have, and based on the different risk-free rates that you have, you're going to have a different graph that comes out. So that's super, super interesting. Now, what I want you to be able to understand is that if we ask you, what is the intercept of your CAL or your CML, it's always going to be your risk-free rate, okay? It's always going to be your risk-free rate, because that's the point at which you're getting 0% risk, but you're getting guaranteed returns, which is why you're at the intercept, no pun intended, okay? Now, just to be more visual, and after I'll ask you a question, is RFB? Hell yeah, you got it. Simple, exactly. So Nar, you passed me a little bit, and I'm gonna show you exactly what we care about right now. I'm gonna give you a quick little rundown on what the CAL is all about. Okay, the CAL, if I would zoom in, and you could really use this to your own advantage. I guess I'll just download this document. Okay. So what's really cool is I built a proof, okay? I built a proof for the CAL, the CML, and the SML, okay? In which you get to really understand, first and foremost, what is the formula? In this case, this is not true, this is not K, but it's RF plus ERM minus RF over OM is times the risk will give you essentially your answer. But what's really cool, what I really care about, is that you can notice, as I said, that this is a linear function, okay? This is a linear function, and a linear function has the form y equals mx plus b. So what I took the time to do is I took the time to literally identify everything you would get from this. So b, as Nar said, it's the intercept. It's the risk-free rate. It's the point at which you have zero risk. So for sure you'll be at the intercept because you have a return, which could be 2%, 4%, 6%, but you hold no risk, which is why you are at the intercept. And then you have your m, which is your slope, okay? And then you have your x, which is going to be the risk. Then you have obviously your y, which will be the output, the expected return. But what's really, really cool is that I think we could all agree that the slope is equal to y2 minus y1 over x2 minus x1, okay? And just giving you quickly a proof is that what's really interesting is that y2, essentially like y2, x2 is 1 point, right? x2, y2 is 1 point on the graph. And then x1, y1 is 1 point in the graph. And if you take the formula that we have here, if you take this to figure out your m, you could quickly plot your line. So what I did here is I created a little proof saying that if you take the return of the market portfolio, or the return of any given point, and you subtract that by the risk-free rate, and then you take the sigmas, or the risk of both points, you'll be able to get to essentially the Sharpe ratio. You'll be able to get to the portion of our formula that you need. Anyways, I feel like I'm talking a lot, but the idea here is that there's a proof that's available to you. And if you're in a member group, all you have to do is you have to go right here in formula sheets, and you'll be able to have all those different formula sheets. But yeah, so that's what I would like to share. Anyways, that said, before we move on to the next step, do we have any questions about the cal? Do we have any questions about the capital allocation line, i.e. capital market line? Is there any ambiguities? Is that clear? Do we understand why it's at the tangency point? Do we understand why we're there? Like, what's up? Do we understand why there's a risk-free rate? Yeah, so the tangent portfolio, okay? The tangent portfolio essentially is the best, okay? And it's actually funny, and I could literally do a proof for you, but it's the best combination, okay, of your risky assets. In this case, it's the best combination of Microsoft and Apple, all right? So as you can see, there's countless possibilities of combinations, and we want to find the one that will maximize your return to risk, okay? And what's interesting is that the one that maximizes your return to risk is essentially the portfolio that you're going to choose to invest in, right? You're not going to choose to invest in the one that maximizes your risk. You're going to try to maximize your returns. You're going to try to maximize that relationship. So that is your tangency portfolio. Now, in relationship to the risk-free rate, in investing theory, people should not invest solely in a risky portfolio. They should invest in a risky portfolio in combination with the risk-free rate. And once you do the two, you could put your tangency point all the way to your risk-free rate. And that's going to give you essentially your capital allocation line. Does that give you any sense? Do you have any other questions? By the way, this is the time. Like, I'm totally here to help. Are there any questions about the cal? By the way, on the mock exams, we're obviously going to do more, questions on that. Yeah, exactly, Parth. That's exactly the question. If you want to find the best relationship between risk and returns on a portfolio, you need to use the Sharpe equation, or you could use essentially just returns to risk. They're both the same thing, right? Unless they want a specific, calculated answer, I would use a Sharpe ratio. But if not, if it's a multiple choice, both of them work super well. Okay. Any other questions about the cal? Because yes, Charlene, exactly. Very good question. So you can move past that, which is why I put the weight as being minus 20%, all the way up to 120%. So you could short, you could short and go 200% invested in a specific portfolio and then borrow at the risk-free rate. But that's not something that you'll see too much on the exam. But yes, it is possible to go further then. And when I had to build this Excel, I had to go further then to really get the full width or the full length and the full scope of the formula. Any other questions in terms of the cal? Any other ideas, questions? What's up? Okay. So that said, this is a very important concept to understand. Now, what I wanted to cover is that typically when we're looking at the capital allocation line, we're looking at a portfolio, right? What we did here is we looked at the portfolio of Microsoft and Apple. However, there's a specific portfolio that we could invest in. That specific portfolio that we could invest in is what we call the market portfolio, right? It's the market portfolio. But how does this market portfolio work? And what's this idea of the market portfolio and why does it matter? If we go back to the first slide, if we go back right here, we notice, I guess I'll have to zoom out. We notice that there's a clear benefit to diversification, especially when two stocks are not positively correlated. There's clearly a benefit to being able to invest in different stocks. But now this leads us to the question of, well, what happens if we invest in several stocks? Or what happens if we create a portfolio that mixes all the best stocks that move in opposite directions? These are questions that I think all of us would probably be interested in if we had a lot of money in the stock market, because we want to reduce our risk. Well, that's what happens when we're looking at, big hedge funds or big investors or people dealing with a lot of money. They want to be able to maximize the effects of diversification. They want to be able to maximize the effect of investing in a bunch of different assets that are not related, at the peak. So what does that do? That actually creates that actually does create an efficient frontier on steroids. Okay, it creates an efficient frontier that's like cracked out of your mind. But what we're going to focus on is we're just going to focus on the idea of really understanding when we go towards this concept of the market portfolio. Well, what is risk? How do we break down risk? And what is the real tangible benefit of diversification? So we're going to try to really relate all of them, and we're going to play a little game to do so. We're going to play the game of building a lemonade stand together. Okay, we're going to build a game of building a lemonade stand together, and that's going to give us a better understanding, okay, a better understanding of what this idea of diversification is all about. Okay, so bear with me. This is not just a joke. This is actually a pretty tangible, example that a lot of hedge fund managers use to explain to their clients what is diversification and why does it matter. Because as we move on to the capital market line, not so much with the SML line, we're going to deal with a whole new risk factor, a whole new way to interpret risk. And that's why it's really important to use this example to kind of build ourselves up from there. Okay, so let's say that we want to invest, and because we love lemonade stands and that's the only thing we can invest in, we want to kind of get a better sense of the lemonade stand business. So before we start our own business on the corner of our street, we need to assess the lemonade stand business. Okay, and there are 3 different individual lemonade stands that we're going to analyze. There's 3 different lemonade businesses that we're going to analyze. Okay, so there's a lemonade stand, and I guess let me know, by the way, if it's too small. I guess I'll go bigger. I'll go at 18 size. Okay, so we're going to have the lemonade stand at downtown. So in downtown, we're going to have the lemonade stand at the suburbs. Then we're going to have a lemonade stand, unfortunately, at the ghetto, in the ghetto, okay? In an impoverished place, unfortunately, okay? So I guess we'll call it in development area. I feel like that's a better way to say it, okay? I feel like that's kind of rude. But yeah, so we have essentially 3 different lemonade stands. And obviously, these different lemonade stands, because of their location, are going to have different profiles, right? The number of people that come to the lemonade stand, the quality of those people who are going to come to the lemonade stand, the security of the lemonade stand, the price that you'll be able to charge, the competition. So what we're going to do is we're going to look at a few little factors. So we're going to look at, we're going to look at the volume, so the number of people. We're going to look at the safety of that area. We're going to look at, I guess we'll do this. We're going to look at the safety of that area. I guess we could look at the competition in that area. So this would be the competition, would be the number of competitors. The safety is the number of threats. And I guess what's another thing that we could look at, for example? Any other factor that you would look at when investigating a lemonade stand business? Are there any factors? I guess wealth. So the wealth of our customers. So dollar per customer. Okay. So Let me ask you, where do you think we're going to find the most amount of clients? Downtown, suburbs, or in a ghetto-ish developing area? Somebody tell me in the chat. This is going to be a quick exercise. Okay, so downtown. Yes, obviously, this is where we're going to write high in downtown. Okay, cool. So what about the threats? Where are we going to have the most amount of threats? Where are we going to have the most amount of threats? In the ghetto, in the suburbs, in downtown, where are we going to have the most safety, concerns? Where will we have the most safety concerns? Can somebody tell me? Yeah, in a developing area. That's probably where we're going to have to kind of, look around when we're taking money, because unfortunately we're in a developing area. Okay, where are we going to have the most competition? Where are we going to have the most competition? Right? Where are we going to have the most competition? Downtown, exactly. We're going to have the most competition downtown. Okay, and where are we going to be making the most amount of money? Where are we going to be making the most amount of money per customer? Once again, this will be downtown. Okay, so what I'll do is just to make it like, I guess I'll put them in green for the stuff that's good, and the competition, I guess, will be in red, and then the volume of people will be in green, so good stuff. Then the threats will be in red. Okay. Whoops. So the reason why I did that is I wanted to highlight these threats. I wanted to highlight these risks. But what I also wanted to highlight is that every single lemonade stand we're looking at has its pros and also has its cons. And also what's really important here is that the risk that my lemonade stand in the suburbs will face are not necessarily the same risks that your lemonade stand downtown will face. Okay, that's very, very, very important. Every single business, in this case, every single lemonade stand will have a specific and individual relationship to these specific threats. Okay, your threat may not be my threat, and your exposure to that threat may not be the same as me. Okay, that's super, super, super duper important. What I just highlighted here is what we call individual risk. Okay, individual risk, right? It's an individual risk. And in your books and in your lessons, what we're going to call individual risk is something that we discuss as being unique risk, all right? Unique risk, unsystematic risk, okay? Now, individual risk, does that make sense to everybody? Is that a term that you could remember? If you see that on the exam, you could understand that. Quick yes or no in the chat. Amazing. Unique risk, is that something that you could remember? Is that something that you could see? Yes or no in the chat quickly, so we can move on. Okay, well, I'm assuming that's a yes. And then unsystematic risk. What does unsystematic risk mean? Unsystematic risk essentially is the risk that is not affected by the whole system. It's not risk that's shared by the whole system. In this case, the system is the market. In this case, the system is like the world, okay? So unsystematic risk is just a different way to say individual risk, all right? So to summarize what we just covered here is that we want to look at lemonade stands. We love the business. So we wanted to look and do a little market study. And we realized that there's 3 locations. And in those 3 locations, they have different exposures and relationships to a bunch of different threats, all right? But then let me ask you another question. Exactly. That's a very good question, a very good insight. Yes. Unique risk is individual risk, is unsystematic risk. Okay. Very important. But then let me ask you another question. Okay. What if there are no more lemonades? Okay. No more lemons. There's no more lemons across the world. Okay. No more lemons. Is that something that's affecting every single one of these businesses? Every single one of these lemonade stands. Are they affected by the fact that there's no more lemons? Hell yeah. That's something that's affecting all of them. No matter what you do, you cannot escape. Those business owners, those little boys and girls trying to make 50 cents off lemonade cannot escape that. That's what we call market risk. That's what we call systematic risk. Exactly. That's across the system. It's across the market. Okay? That's something that no matter what you do, you cannot escape it. Once again, that's what we call systematic risk, okay? It's just something that you can never escape. Now, what's really interesting, by the way, let me just say, is that clear? Do we now understand what systematic risk is versus unsystematic risk? We see the nuance. Amazing. So what's really interesting is that obviously, if we had to do like a risk profile, obviously, downtown will have a different total risk than the suburbs, and the suburbs will have a different total risk than oh my god, and the developing area. I guess I can't say it for some reason, but the area that's developing is the one that also has a different, risk profile. So the idea is that the total risk of these different lemonade stands are once again different, but the unique risk, that portion will not be different. Okay, so that's just something that I really want to make clear. We could always make it into a graph like this, and the way they usually do it is they create this idea of a line that goes through just like that, and they draw it out. This is in my notes, that's why I'm kind of making it ugly right now. But the idea that right here, this is what we call systematic risk. But this portion right here is unsystematic risk, okay? Now, the reason why that's important, the reason why this is very important, and the reason why this is cool when we look at it at scale is that, well, we went back to our different conversation, okay? Let me ask you a question. Oh, sorry, which one was systematic? Like, let's say this is risk, and then this is the number of, companies. But actually, let me even go further than that. Just that's something I thought about before I did the session, and I wanted to share it. So let's say now we're like, what? Buck that. We're not gonna start the lemonade business. What we're gonna do is we're gonna use the money that we were gonna place into making our own lemonade stand, and we're gonna invest it across these different, lemonade stands that are already existing. So the one downtown, the one in the suburbs, and the one in the developing area. So we want to invest in those three. Now, with the knowledge that we're equipped with now, would we think that it's a better idea to invest in only one lemonade stand, or should we invest in all three lemonade stands? What do y'all think? What do y'all think? All three, right? Because we have the benefit of diversification, especially because we see that one threat of downtown may be a win for the developing area and so forth. So obviously they're not positively correlated. They're kind of like in the middle there. So that's super important, okay? So let me ask you this. What we just did there is we literally tried to minimize our exposure to unique risk. Because let's say we had $100, right? What we did is instead of just putting $100 downtown, we decided to put $30 here, $20 here, and then $50 here to minimize the exposure of this person's red stuff and maximize perhaps this person's green stuff and so forth, okay? So that's really important. So as you can see, if this is just one stock and then this is like 3 stocks and this is like 10 stocks, etc., as we invest in more and more stocks, we're able to reduce our approach at unique risk and maximize our approach to market risk. So long story short, NAR, this portion here is going to be market risk, and this portion here, which is the big portion, will be unique risk. A really good way to visualize that is by simply looking at this, right? So the red part is the market risk, and that's something that can never be, undiversified. And the rest is unique risk that could be diversified or could be eliminated. The idea with diversification, and by the way, I'm just throwing so many words at y'all because I want you to understand. Unique risk is essentially something that we're trying to get rid of. We could only get rid of it the more we start investing in different assets, the more we start diversifying. Okay, it's like a bug, you gotta take that bug off, then you invest in another one, you take in another set of bug offs. That's the idea. The idea is that the more you invest, the less you're going to be exposed to one's big, risk factor. Okay, so that's it. So now we know that. Okay, and if we go back right here, all right, if we go back right here, and we try to make sense, and like let's just think about it rationally. Let's say you're the first investor ever, and you realize that Yeah, 100%. 100%. Because it's not so much a unique risk is being eliminated, is that you're eliminating your exposure to that risk. It's like if you had a friend that would always hit you when you see them. The more you see them, the more you're getting hit. But the less you see them and the more you diversify your group of friends, the less he's going to hit you. That's the same way to look at it. No, systematic risk is always the same. Systematic risk will never change. Okay, it's always the same thing. Systematic risk, essentially, if I go back here, risk is a combination of two things. Okay, and I'll zoom in. Risk is a combination of two things. It's a combination of unique risk and market risk. Okay, so from which we're going to be able to have our total risk. Okay, so what you do is you take your unique risk plus your market risk, and that's going to give you your total risk for that specific, like, business, asset, security, stock, blah, blah, blah. So the idea here is that your systematic risk will never change, but your unique risk will change. In your portfolio, ideally, you want to get as close as possible as the systematic risk that nobody could escape from. Okay, so that's the perspective. Now, that said, imagine you're the first person that discovered this idea of like diversification. You invested into two assets and you're like, holy snap, my returns, okay, my returns, or at least my risk, was much less than that of those individual assets. Okay, you're like, God damn, that's pretty crazy. So imagine the first person that realized that, the first investor that realized that. He's going to be like, okay, well, what if I start investing in more and more companies? What if I start investing in 100 companies? What if I expose myself to only all of the best companies out there? That's exactly what we're going to do with this idea of the market portfolio. Okay, the market portfolio is the combination of all the assets that are available in the market in the best possible way. That's like a very hard project task to do, but there are people who did that, and they're able to create the market portfolio. They're able to mix all of the portfolios out there and figure out what would be the best absolute combination. So remember when I said that it was the efficient frontier, but on absolute steroids? That's exactly what the market portfolio is. It's like an infinite set of stocks, okay? And they're going to find the best absolute combination. So that's where we get this idea of the market portfolio, okay? And the market portfolio nowadays, the best way to kind of like talk about it and the best way we do it in class if you're going to take finance is what we call the S&P 500. The S&P 500 is essentially a mixture of all the best stocks out there with different weights. So this is the weight of Apple, this is the weight of Microsoft, and so on and so forth, all the way to 100%, right? So the sum of all these will be 100%. And the market portfolio is the mix of all these, okay? And that's going to create what we call the market portfolio. Now, what I want you to understand, when we're going to this idea of CAPM, when we're moving towards the SML, essentially, we need to make a few assumptions. We need to assume that everybody has access to the same amount of information, that everybody has access to the same, liquidity when it comes to capital, that everybody's able to invest the same amount of money, that the amount of money they invest will not have a change on the price, that everybody has access to the same information, that everybody understands movements, and that it's a rational playing field. That's what we need to understand. But realistically, we don't have those assumptions. We cannot follow those assumptions. We cannot follow those rules because I don't have perfect information. You don't have perfect information. But big hedge funds, big investors, big governments, they do have that information and they do have that know-how. Like, for example, the government of Canada has analysts that works for them. They have so many different resources available to them. They have people that look at this every day. Ray Dalio, right, at Bridgewater's Associates, Goldman Sachs, the Bank of Montreal, all of these different institutions have the resources available to move in accordance with the market, okay? So they would obviously have enough money to invest in all of the different assets in a bunch of different ways, and they may also decide to just invest in this market portfolio, okay? So this idea is that there is this market portfolio. There is a portfolio that we're going to call ERM, that is the optimal, okay, the optimal risky portfolio. In theory, that there's this optimal risky portfolio that's going to be called the S&P 500. It's, that's what you need to know for now. So there's this optimal risky portfolio that combines all the portfolios out there in the market, okay? But the thing is, when we're looking at all of the different assets, all of the different securities, all the different stocks in the stock market, we need to use a different benchmark for risk. Why we need to use it, whole different topic, but we need to use a different benchmark for risk. And that different benchmark for risk, can somebody tell me what it is in the chat? What is that different benchmark for risk? What do we call that when we're looking at the SML? What do we call that different benchmark for risk? Do we call it risk? Do we call it alpha? Do we call it beta? Do we call it Snoop Dogg? Do we call it football? What do we call it? What is the benchmark for risk that we use under the SML when we're looking at the market portfolio? Under the SML, what is the benchmark? What is the, there you go, Park, thank you. We use beta, okay? Beta, I don't need to go too deep into it, but beta is simply the covariance of a specific asset, asset X, with the variance of the market portfolio over the standard deviation of the market portfolio. That's what you need to know. Will you see that on the exam? Not necessarily. Will they always get, like, typically, yeah. They will typically give you beta, like 95% of the time they give you beta. Like, I would not optimize to learn the formula by heart. I would probably just put it on my cheat sheet and kind of just do the questions that are related to beta in which they give it to you. What I do want you to know, yeah, X is just a stock. Sorry, it could have been like A. I could have said, for example, as well, I could have done like, just because I'm writing with my mouse, but I could have done like, you know, this of like Apple with, you know, the market over the market. Like I could have done that as well. And that's beta, okay? So that's important for you to know. But what I want you to remember, and this is important for you forever, what this means, what we have on the screen is essentially saying, what is the contribution of one security's standard deviation to the standard deviation of the market? I'm gonna say that one more time, okay? What is the contribution of one stock's risk to the market risk? Let me say that another time. What is the contribution of Apple's risk to the risk of the market? Another time for you. What is the contribution of Apple's risk to the risk of the market portfolio? That's what beta is all about. Beta is trying to assess what is the contribution of one singular stock's risk to the risk of the portfolio, right? Because different stocks, I got you. So beta analyzes the contribution of one stock's risk to the risk of the market, okay? Beta analyzes the risk of one single stock and then looks at its contribution to the risk of the market. That's exactly what it does. So for example, let's say a super risky stock like GameStop. Remember that? Remember the whole golden hands or whatever it was called? Well, GameStop's risk obviously contributes to the risk of the portfolio in different ways, right? It's a very risky stock, but it also doesn't really contribute a lot to the, you know, the general volume of the market. So the idea is that based on a bunch of different factors, how does that affect, you know, the total variance of the market? So that's the idea, okay? You know, now that you have it in the back of your mind, it's probably useful to know. If you want to even write it down on paper, just to kind of have that active recall. So that's the idea here, okay? That's what we want to know with beta, all right? That's what we want to know with beta. But what's interesting is that with beta, we're able to actually find our SML. Our SML will literally look at, it's very similar. It's going to look at beta, okay, on our x-axis, and it's going to look at our expected return on our y-axis, okay? That's what our SML is going to be like. And our SML will once again kind of look like this. We're going to have our risk-free rate right here. And then we're going to have our market portfolio here. Okay. Which is going to be our market portfolio. Can somebody tell me what's the beta of the market portfolio? Does somebody know in the chat? What's the beta of the market portfolio? What is the beta of the market portfolio? What is the beta of ERM? What is the beta of the market portfolio? If you know this answer and you never saw the actual answer, you are a pro. Yes, it is 1, exactly. So I just want to get a little bit more technical for you to always remember this no matter what, although it's easy to remember. The reason why the beta of the market portfolio is 1 is because obviously the contribution of the market portfolio's risk to the market risk is obviously going to be, kit. It's going to be the same thing, right? The market portfolio, right, has the same, like the market portfolio's risk is the same as the market portfolio's risk. So if we would put that into our formula, just to make that super clear, it would literally just look like this. It would look at the covariance of the market portfolio to the market portfolio over the market portfolio. You see what I'm saying? So that's why it's equal to 1. Because the covariance of the market portfolio to the market portfolio is obviously going to be moving in the same direction. If we look at this, this is the market portfolio and this is the market portfolio. Because they're the same thing, right? They're literally the same thing. If this one goes up, this one will go up as well because they're the same thing, okay? And for that reason, your covariance would be a unique value, right? And then your standard deviation, right, will obviously be the same. It'll be the market portfolio. And for that reason, it's equal to 1. Anyways, the idea is that the covariance would be the same value as this, okay? And that's the idea. That's why it's equal to 1. Do you need to know that? Maybe not, but it's good to kind of have that understanding. So that said, what we'll do is we're going to move on to this idea of the good old SML. But before we move on, do we have any questions about beta and the market portfolio? Like any nuances, any questions? What's up? Okay, seems like we're good. All right, then. So let's move on to the SML. All right, let's move on to the SML. SML. So the SML, what's really cool with the SML is that too, I guess if we go here, there you go. So if we go here, the SML, also follows the same idea. As I said, the SML is once again simply a linear function, right? And it looks like this. I would add this to my cheat sheet type of thing. And the SML takes the form of a linear function equals y mx plus b. Y equals mx plus b, sorry. And you could also solve to find the slope of this SML by simply just using this proof. And as you can see, because we know that the beta of the risk-free rate technically in this case would be 0, and the beta of the market portfolio is 1, we would obviously just have 1 as our denominator, and then obviously our numerator would remain the same. And then from which we're able to quickly see that our formula is very simple and less complicated than the one of the CML. So you can use this to your advantage. So really good cue. If you're in a member group, once again, remember that it's right here. Okay, super important. Now, with that said, what I want you to understand is that quickly, when we look at our SML, we have K equals RF plus beta times the market risk premium. Okay, what is the market risk premium? I'm just going to explain it super quickly. The market risk premium is very similar to what we said before. This idea of $50,000 versus trying a new job. The market risk premium is us assessing, well, what are you getting extra over the risk-free rate? What is a market portfolio giving you over the risk-free rate? So in this example, if our market portfolio, right, if our market portfolio is, I don't know, call it 11%, and our risk-free rate is 3%, then what would be our market risk premium? Can somebody tell me? What would be our market risk premium in this case? What is our market risk premium? It is 8%, exactly, right? Because all we did is we took ERM right here minus 3%. Okay, thank you so much, Nar. Thank you so much, Charlene. I appreciate it. So that said, what I want you to be able to visualize here is that the formula is pretty straightforward. Formula is pretty straightforward. And what I want to do is I want to play a game. I want us to be able to understand, well, how do we figure out if a stock is either undervalued or overvalued or fairly valued? And before I get there, I'm just going to ask you to ask me some questions. Do we have any questions whatsoever about the SML? Literally any questions out there. Anything works. Anything is a good question. Because I know there's only so much I could say, right, without knowing what, where you're at within the whole field. So if you have any questions, do not hesitate to ask. All right. So that said, I think we're pretty okay with this idea of the SML. I feel like it makes sense. So what we're going to do now is we're going to try to assess what happens based on different, little computations that we do. Yeah, for sure. I mean, that's totally fair, Charlene. You guys literally just came back from the exam. I also. So it's totally fair. Totally, totally fair. So what I'd like to do. What's going on here? Sorry. So what I'd like to do is I'd like to play a game. I want us to figure out what happens, okay, if something, okay, if we essentially, let's say we have a bunch of securities, right? Let's say we have a bunch of securities with a bunch of different beta profiles, okay? And what we want to do is we want to plug them in within our formula to figure out what would be our required rate of return, because that's exactly what this formula is all about. We're trying to figure out what would be your required rate of return dependent on what type of stock you're investing in, because every single stock will have a different contribution to the market risk. Every single stock, in other words, will have a specific beta. Okay. So what we're going to do now is we're going to go through one by one and we're going to try to assess what's going on. So let's say, okay, and let me just do one thing really quickly. 0. Okay, so let's say that we have Apple. Okay, let's say we look at Apple. All right, and we know that the beta of Apple is equal to 1.19, and we know that the expected return for Apple is 19%. Okay, this would mean if you guys would plug this in, I guess I'm going to hide this. If you were to plug this in into your formula, if you were to plug this in here, could somebody tell me what would be our required rate of return? If you were to plug this in within your formula, what would be your required rate of return? Knowing that the risk-free rate is 3%, that the expected return on the market is 11%, and the beta of this security is 1.19. What would be the required rate of return? What would be our K? What would this be? So let's see if that's correct. 12.52. No, it'd be 12.02. Okay? It would be 12.02. And don't worry, we're going to do this for every single one of them, so you'll have some practice to give it a shot. But it would be 12.02. Now, that's one thing. Now, what I'd like you to understand here is that now we figured out what's our K. I think we could all agree that this point right here, this black point right here, okay? Whoops. This black point right here, this one right here, okay? Just making it super clear. I'll even put it in yellow. This yellow point is going to be our required rate of return. It's going to be our K. So if we know that our K is 12.02%, but the estimated returns for this specific, okay, for this specific asset is 19%. What does that mean? Does this mean that it's overvalued, undervalued, or fairly valued? What do you think? What would that mean to you? If anybody had to take a guess. I need everybody to give it a shot. I see one answer. I see uno answer. So what do y'all think? So our red point is right here. Our expected return. Okay, yeah, no problem, no problem. So what we're trying to do right now is we're trying to figure out whether a stock is fairly valued, overvalued, and undervalued. And I'm just playing off intuition for you guys. Okay. So we figured out that our K, I'll even put it here. Our K was 12.02%, but our estimated returns for this specific portfolio, this specific asset, was 19%. Now I'm asking you, is Apple overvalued, undervalued, or fairly valued? What would you say? Charlene says it's undervalued. Hart says overvalued. What about NAR? What about Charnel? What about Rami? What do y'all think? Okay, well, anyways, the answer here would be that it's going to be undervalued. The stock is going to be undervalued. And there are three ways, but there are two ways that we're going to look at today to make sense of that. Okay. What I would say is that actually there's four ways. If your estimated returns, if the ER, if ER is bigger than K, right? If ER is bigger than K, you have a stock that is undervalued, right? If ER is bigger than K, you have a stock that's undervalued. Another way to look at that is if the ER is above your security market line at that given point, then you have a stock that is undervalued. So in other words, it's still saying that it's bigger than your K. Another way to look at this is simply by understanding what risk is all about, right? Essentially what we're saying here, and I think we could all agree, the more risky an investment, the more risky a stock, the more we should be compensated for taking that risk, right? In other words, the bigger the beta, the higher the expected return. And if that doesn't make sense visually, like mentally, it can make sense visually. Because as you can see, the bigger our beta, the bigger our expected return. Obviously, this point with a beta of 2.2 has a bigger expected return than this point right here or this point right here. So that's an intuitive way to make sense of it, right? Now, yeah, no worries, no worries. Honestly, I'm always like viable to make a mistake too. But how it would work, let me just make sense of it. So we have 11. Oh, I think I got you. Sorry about that. That's on me, man. I'm so sorry. It's 10.5 just because it rounds up. I apologize. Sometimes it rounds up if you don't make a change, and that's on me. My bad, my bad, my bad. That's you knew what you were doing. I'm so sorry about that. But what was I saying? So a good way to see this is that for something to be undervalued or overvalued, without even looking at prices, we really need to remember what risk is all about and what is the return to risk like dance that we're having. The more risk we're taking, the more we should be compensated in terms of returns, okay? So what we're telling you right here is that while we try to estimate the returns that are required through the CAPM equation, we could try to compare what's required through the CAPM equation to what's actually given in the real life, in the real field, in the market. So what we did here is that we looked at Apple. We said, okay, Apple has a beta of 1.19. We plugged that in within our CAPM formula to estimate what should be the expected return or what should be the required rate of return for Apple. We get 12.02%. So we're telling you that, hey, for this level of risk, okay, for the risk of 1.19, okay, for the risk of 1.19, you should only be getting essentially 12% worth of return. But what you're seeing here on the graph, and essentially if you just look at the numbers, is that you're able to get something much bigger. You're able to get essentially 19% for that same level of risk. So that's very, very important. You're able to beat what you're supposed to receive for that given level of risk. And I'm going to talk about this from another perspective again, just to make it clear. So what the CAPM formula is telling you, it's like a mass predictor. It's a mass tool to approximate returns. Okay, that's what CAPM does. And when you're plugging stuff in within CAPM, you could plug in essentially Apple with a beta of 1.19. And CAPM, like a person, is going to tell you what return you should expect. And the return they're telling you for a beta of 1.19, given a market risk premium of whatever amount, should be only 12% and no more. Okay. However, this Apple stock is giving you 19%. So you're getting much more than what you should be receiving for that level of risk of 1.19 beta. And that's why it's undervalued, because you're getting a steal. You're getting much more than what you should be getting. Okay. Does that make sense? Is that a good way to think about it? And if so, we're going to move on to the next ones. Okay, cool. We're almost done. We're almost breathing. Yeah, sure, no problem. So we're going to do the second one, and then we're going to try to double down on that right now. So check it out. Let's look at Microsoft. So Microsoft has a beta of 0.94 and an expected return of 12%. I need y'all to, everybody tell me in the chat, what would be our required rate of return? Okay, what would be our required rate of return if we would plug in, all right, if we would plug in 0.92, or I mean, sorry, 0.94 in our formula. So what would be our expected return if we plug in 0.94 as our beta in our CAPM formula? What would that be? What would that give us? What would that give us? What would that give us? Everybody write in the chat. Everybody write it down. So I got two answers. I need Nar, Rami, Charnel, everybody to give it a shot. If beta is 0.94 and the risk-free rate is 2.5 and the expected return is 10.5, what are we getting? Okay, what are we getting? Charnel, what do you got? What is your answer if you plug that in? If your risk-free rate is 2.5%, your beta is 0.94, your ERM is, yeah, okay, cool. So we have 0.94, okay? And this would mean that we would have 10.02 as our K, all right? 10.02 as our K. So now I would like to ask you, what would be the relationship here? So our formula, CAPM, is telling us, hey man, you're supposed to receive 10% for this stock. Yet in the market, we're getting 12%. Okay, so that means that ER is bigger than K. That means that our ER is above our SML line. What does that mean? That means that we're getting a return that's higher than what we should be getting for this level of risk. So is this undervalued, overvalued, or fairly valued? Charnel, what do you think? What do y'all think? What do you think, Charnel? I'm getting 3 undervalued. There you go. I love it. Amazing. Hell yeah. Cool. Good stuff. Good stuff. So yeah, it would be totally undervalued. Now, once again, I just want to reiterate it. I sound like a broken record, but what CAPM does, it approximates the amount of returns you should be getting for a specific beta. All right. In this case, our beta was 0.94. We plugged that in within our CAPM formula. It returned 10.02% as our required rate of return for a security with a beta of 0.94. All right. But we know that Microsoft actually has an expected return of 12%. So for that same level of risk, right, you're getting 12% when you should be only getting 10%. So you're getting a steal, right? You're getting a steal. For that reason, it's undervalued. All right, let's do the same exercise for now. It's classic Amazon. All right, so plug in 1.23 into our formula and tell me what we get. Everybody in the chat, please tell me what do we get. at 1.23. I got one answer. Yeah, for sure. This recording will totally be posted. Don't even worry about it. And we're going to be done in a few minutes. I know we went way over time. And I'll give you homework though. So the questions to do, where to find them, and then also kind of like what's the next steps for the next session. So don't you worry. We're done in like 2-3 minutes. At 8 o'clock, I'm going to start doing them myself just to get it done quickly. So what is our required rate of return? What is our K with a beta of 1.23? What is our K with a beta of 1.23? What would that be? I got one answer by Parth. Thank you so much. I need like 2 more answers. No, exactly. The beta is not a percentage. The beta is a like number. It's a p. It's a integer. Not really. It's a rational number. So it's not a percentage. Damn. Yeah, it's not a percentage. Explanation wasn't great, but it's not a percentage. Everybody put it in. It's okay. 1.23. I need everybody to give it a shot. So Hart says 11.46. Charnel says 12.34. I need maybe Charlene and Nart to give it a shot. No, I was not a TA, but I got A in the class when I took the class 2 years ago. Just graduated a semester, and it's my last semester teaching the class. But yeah, so never a TA, but I got A in the class. Been a tutor for 2 years now. Helped 4,000 students to date. It's pretty cool stuff. Anyways, but yeah, so let me tell you guys what it would be. So if our beta is 1.23, okay? If our beta is 1.23, we would get 12.34. So congrats, Charnel. So let me walk y'all through this one more time because I need everybody to get it at least once all together so we could leave, in good standing. So if our risk-free rate is 2.5 and our beta is 1.23 and our ERM, right, is 10.5, and this obviously remains to be 2.5, we would get 12.34. Could everybody like do it one more time? So that would be Charlene, that would be Parth. Okay, y'all got it? Amazing. Okay, cool. We're gonna do another one. Okay, we're gonna do another one. So let's give it a shot. Now, by the way, let me ask you this. In this case, if your required rate of return was, oh, my bad, by the way. I was supposed, yeah, let me just do these. No. Just you, the way you could do this is either you could do it all of it as percentages except the beta, or you could just all plug them in as normal numbers. It's the same thing, right? You're always, the only difference with a percentage is that you're doing times 100 or divided by 100, right? That's what it is. So if I were you, just do it without the percentages at first and then maybe add a percentage at the end. But that's a little mental game you could do on your own, right? So it's really up to you what works best for you. I would say the next one, we're all going to try it without anything. But anyways, before we move on to Exxon, let me ask you this. So if our expected rate of return is 10.95, okay, and our required rate of return is 12.34, is this overvalued, undervalued, or fairly valued? One more, I need one more answer, but that's very good. Is this overvalued, undervalued, or fairly valued? Yes, it's overvalued. Now, let me just play again with that thought. It's that one, if your ER, so if your expected return is smaller than your K, that means they're getting less returns that you're supposed to get for that given level of risk. And for that reason, you're paying way too much. You shouldn't be getting that stock at that level of risk. You're taking too much burden of risk over what you should be getting. And for that reason, it is overvalued. okay? And if it's underneath the line, it's overvalued, as you could see. Your expected return is underneath your required rate of return. Imagine you expect to get less than what you require. Imagine, that's crazy. So let's move on to the last one that we'll do together. All right, we'll do the last one together. Beta given security. So let me ask you this. If our beta is 1.05, all right, if our beta is 1.05, what would be our, whatchamacallit, our required rate of return? If our beta was 1.05, I just need like 1 or 2 answers and we'll call it a day. If our beta was 1.05. 10.9 Charnel. I need 2 more answers. Oh, or 1. Like Parth, Charlene, y'all can give it a shot. What would be our whatchamacallit? Our K? What would be our required rate of return if our beta is 1.05? Okay, cool. So we notice that ExxonMobil is giving us an expected return of 15.79%, and our K is 10.9%. So is this undervalued or overvalued? Undervalued or overvalued? Undervalued or overvalued? Our ER is bigger than our K. So yeah, undervalued. So just for fun, I'm going to do one last one. Okay, now I'm just going to answer the last ones real quick. So if our beta is 1.37 and we're expecting 9.93. So let me ask you a question right now. So if for Facebook, our return is 9.93 and our K is 13.46, is this overvalued or undervalued? Just quickly in the chat if you can, I'll give you 10 seconds. 1, 2, 3, 4. There you go. Exactly, because we're getting less than our K. So for that reason, it's overvalued. And then the last one, well, this one is kind of cap, but it's kind of cap because it would stay on the same line. But anyways, this one doesn't really count. But yeah, this one would be the same. But anyways, for that reason, I think we are good. We're gonna call it a evening. We did 2 hours. It was very fun. But before we call it a day or an evening, we're gonna just quick. We didn't have time to look at practice problems, and I'm pretty sure you would not want to look at practice problems from now on. At 2 hours in, you probably have a headache of hearing me talk. But what is cool? Well, yeah, because to be fair, I just didn't want to spend too much time on that. If your beta is 1, right? If your beta is 1, and the estimated return of, I think it's the only thing that has a beta of 1 is the S&P, okay? And the reason why I made a little mistake is because I didn't put the same value here, okay, as here, but they are the same values, right? The expected return of the market portfolio is the same thing as the S&P, which is the ERM. So for that reason, if it's 1, right, it'll be on the line because it's a market portfolio. So yes, then it would be properly valued because it's the market portfolio. All right. So just a little bit of context there. But yeah, that said, we do have a session on Saturday, and this is for the people. So this is literally Charlene and Rami. And for those of you who are interested and those of you who are looking at the recording, we will have a session on Saturday. What I will do though is I will administer homework, and I'll administer this homework to everybody. And everybody that wants to just, have a candid talk with me or put it in the chat or whatever, I'm more than happy to help. I say that for the next session, or at least for Saturday, I'm going to keep tabs. I would probably recommend that you do the following. Now, this could be found on my website. This is not a plug, it's free stuff that's available for you on my website. If you go to Concordia and then you go click Comp 308 and you go at exam 2 material, right? So free practice problems. you're going to find literally 45 pages worth of practice problems. If I were you, what I would do is I would actually go all the way down to chapter 9. There's a lot of questions, so give me a sec. I would go all the way down to chapter 9 and do all of the questions, or at least as many questions as possible, starting from this one. Do as many as you can. And then on, call it Friday night. And Friday night, I'm going to ask the peeps to essentially to share their work in the chat. Okay, I want you to be held accountable. I want you to work hard towards solving stuff. I don't think there's a reason for which anybody should be getting 40% in this class. Okay, so by the way, CAPM is pretty much everything that's in chapter 9. This is literally chapter 9 is CAPM. So I would do all of chapter 9 questions, or at least as many as you can, because they will all cover a little bit of what we've discussed, except for like the weighted beta questions. But for that, don't you worry. For the beta specific questions, you could go on my YouTube page, and there's this video right here, which is very good. Like, not blowing my own horn, but it really goes in depth in one of the questions you'll see on your exam, like most likely. It relates to beta. It's a missing beta question. So you could always do that one. But what I'd like to continue on, though, for all of you that want to be like a part of the movement or part of the held accountable, and let's get more than 50 or 70% on the final, I would suggest doing this homework, doing as many questions for chapter 9, so for CAPM, by Friday evening or Saturday morning, and then send your work in the chat or send it to me and ask me questions, right? Make it, make use of it. And by doing this, you will maximize your odds of getting a very good grade and surprise yourself on the exam. So that's what's available to you. Now, those of you who are in the member group, just don't forget that you could click here, more exam 2 materials, and you'll have a bunch of stuff on exam 2. So a solved mock exam, another solved mock exam, another solved mock exam, some practice problems that are solved, and some other practice problems that are solved. If you go into our formula sheets, you're going to have a bunch of different formula sheets available to you to kind of like use them as you're studying, use them as you're doing the questions. Very useful stuff, very important stuff. Another thing that I'd like to share, for those of you who are in the thing, you could go into bootcamp recordings are here, and you could also go, by the way, if I'm not mistaken, where would they be? They would be past crash course recordings. They'd be right here, and you could open this document, and you're going to find all of the old exam 2 stuff that's like important. Okay, so always valuable to do that. Now, what I'd like to say is, yeah, so I don't think there's a reason for y'all to do bad on the final, especially if you do the stuff. Session on Saturday at 12, homework to be done by then, hopefully. And for those of you who are interested, who want to know more, just send me a message. I think there's value here. And my last shameless plug, I guess, would be if you go here in testimonials. I mean, there are countless students, I never share this, but that willingly said that this was a good experience. Most of my students get B+, get good grades, especially if they do everything. So anyways, that said, have a good evening, work hard. Recording will be posted in a bit, and hopefully this was helpful. And yeah, have a good evening.